Today we're going to talk about one of the most tax efficient ways for you to sell your business and retire. So stay tuned, you're going to enjoy this one. Today I want to spend some time talking to you about how you might want to think about selling your business. Now before we get into the idea, I want to just make you aware of something that often gets overlooked when somebody's looking at selling a company. Now let's say, for example, you've got a corporation here and you're the majority stockholder and you're getting close to retirement and you want to retire, and let's say, for example, you've got two young shareholders that are in the business that are saying, you know what, when you retire, we're going to step up and buy your stock. Now, they may pay you out of corporate earnings or they may borrow from the bank. But here's one of the big deals, one of the things that gets overlooked all the time, and it's the tax cost of buying out a retiring shareholder. For example, let's just keep this super simple, and let's say, for example, that this share of stock is worth $1. And this corporation and these young shareholders are going to have to come up with the money to pay you your dollar. What that means is the corporation has to earn $1.43 in income, and they've got to pay 43 cents to the federal government in taxes if you're in a 30% bracket, just to have $1 to be able to give it to you. So let's say, for example, the corporation gives you your dollar and you put that in your pocket. We're done, right? No. You just got $1 for your stock, and the question is going to be, did you profit by selling that stock? Now let's just assume you have almost no basis in the stock when you sell it. You could turn around and give another 20 cents in capital gain tax to the government. So just to purchase a $1 interest of stock, between what the corporation pays in tax and what you pay in tax, guess what you lose? You lose 63 cents. 63% goes out the door in taxes if you buy stock the way most people go about buying it when a person retires. So as you can see, that is a massive tax cost. So let me show you an idea that is kind of unique. Now, first of all, before I do, the person that would be interested in this sort of a concept is typically somebody that really cares about allowing the employees in the company to become stockholders. And they have a burden to help young entrepreneurs have the opportunity to own stock and manage the future of a growing business. So here's the idea. You can set up what's called an employee stock ownership plan. Now this plan is a retirement plan. You have to follow all the federal rules that you have to follow for 401k plans and pension plans and profit sharing plans. But the federal government likes these kinds of plans because what ends up happening is wealth in the form of shares of stock gets handed down to the employees and to the rank and file employees, and the government likes that. So there's some big time incentives for you to enter into an ESOP as far as the federal government is concerned. So let's say we set up an ESOP, an employee stock ownership plan. The concept is this. The corporation, rather than buying your stock outright, sets this ESOP up, and it's the ESOP that ends up buying your stock, not the corporation. But the ESOP needs money, right? So what you do is you arrange for financing from a bank. The way you can tell that's a bank is because of the pillars. All the banks have pillars, right? So what ends up happening is the bank provides the money to the ESOP to buy the stock. So the ESOP provides the money to you so that you're able to sell your shares right back to the ESOP. Now guess what? The first bit of good news is that when you sell your stock to an employee stock ownership plan, to the extent that you got any capital gain, if you set things up right, you can completely eliminate the capital gain tax that you'll have to pay when you sell your stock. So that saves you 20 cents. But here's something that's really cool about this. The government allows you, as a corporation, to put up to 25% of your payroll into this ESOP and deduct it as a business expense. So when you do that, you get rid of that tax. So you create a completely tax-free transaction when you sell your shares to an ESOP, and the payments that are required to pay the bank back are made on a tax-deductible basis. So here's where it gets really cool for the employees. Let's say your debt to the bank is really high when you start. A typical amortization schedule drops that debt down to nothing. Your typical loan that you'll have will be something like a 7-year loan is what you're looking at. So here's the deal. As you begin to pay down that debt and equity begins to build up, that equity goes out to the employees that you have working for you in the form of shares of stock in the ESOP. So over the long run, your employees begin to build wealth, something they would have never been able to do had you not set this sort of a strategy up. So to summarize all this, it's my personal opinion that you shouldn't even consider doing an ESOP unless your company is worth $5 million or more in market valuation and that you have an annual payroll of $1.5 million or more. It's pretty expensive to set these up compared to your typical retirement plan, so you wouldn't want to consider it if your company's under $5 million. But it's a really great strategy for the right company. If you'd like some help trying to figure this out, we prepare a preliminary assessment that will go through all the details of setting a plan up, looking at the financing you need, anticipating what the tax savings will be if you put this sort of a transaction together, and help you work out all the details before you even think about going to the next step. So if you'd like some help on this, just let me know, give me a call, send me an email, and I'd love to help you work through these things. Thanks so much, and we'll talk to you soon.